Hi, it's Paul Seabridge here. I just thought I would share a quick video on interpreting the financial information of a company. So some of the terminology that you might see when looking at financials and talking to accountants is balance sheet. This is basically a statement of assets and liabilities that a company may have. An income statement, often referred to as a profit and loss account, shows you what money the company has billed in terms of revenue and what it's cost to run, and if that figure is north if expenditures are less than income, then there's profit, and if expenditure is more than income, then that would result in a loss. You then have assets. Assets are tangible and intangible. So on a fixed asset point of view, these could be things like property, real estate, plant and machinery, fixtures and fittings. Current assets are basically liquid assets that could be turned into cash within a year. So that could be cash held at the bank, that could be debtors, often referred to as trade receivables, so customers that owe the company money, and stock. You then have liabilities. So these, again, current liabilities will be liabilities that need to be settled within a year. These could be trade payables or trade creditors. They could be loans or overdraft, for example. And longer term liabilities tend to be things like mortgages, overdrafts, long-term loans. Income is basically revenue, so money coming in to the business, sales, if you like. Cost of sales are things that are direct costs to produce whatever it is that you're providing. So if you're a manufacturing business, for example, and you're selling a particular product that you've manufactured, then the raw material cost would be a cost of sale. And that would then give you your gross profit. And then operating expenditure is general day-to-day expenses for running the business. That could be staff wages, rent, rates, utilities, those sorts of things. And depreciation is basically writing down the value of those assets. So going back to looking at those fixed assets, you may buy a car for a member of staff to drive around in a company car. What you buy that company car for at closing over a period of time will depreciate in value, and you will depreciate that within the accounts. And amortization is a very similar concept, but that applies more to intangible assets, so things like goodwill or any intellectual property that you might want to depreciate within the account. So having a look at a real live example, you can see here that we have fixed assets in this company of £342,000. That's as investments. This particular company has a number of subsidiaries, and they bought those companies, so they've basically capitalised that on their balance sheet as an investment. You can see their current assets. They have debtors of 1.6 million, cash in the bank of 1.1, which gives a total current assets of 2.7 million. Creditors, amounts falling due within 1 year, or as you could refer to, current liabilities of around £1 million, and that gives their net current asset position, which is basically their current assets less their current liabilities, gives a net current asset position of 1.7. So total assets less current liabilities is 2.1. Creditors, amounts falling due after more than 1 year, is 9.8. £9,871, and that's a long-term liability. There's no provision for liabilities, and that gives a net asset position of 2.1 million. So the net assets is quite a key component when I'm looking at structuring deals, because I'm looking at, if we bought the shares of this company, what's the net book value of the company? So on day of closing, I will buy this company, I will own the shares in that company, and the total assets less the total liabilities gives a net position of 2.1. And the reason it's referred to as a balance sheet is that your assets and liabilities will always balance. So you can see here that the net asset position of 2.1 is represented by the share capital of the company of 200 grand and the profit and loss account, which stands at 1.9. And you can see that those two things add up to the total equity of 2.1 million, which is the same as the net assets. This is an example of a profit and loss account or an income statement. You can see that this company has a turnover or revenue of 2.7 million, has cost of sales of 140 grand. That gives a gross profit of 2.5 million. Its operating expenditure, or in this case, it's referred to as administrative expenses, so things like staff, rent, rates, utilities, is 1.1 million. That gives an operating profit of 1.4 million. You can see that the company's received interest, maybe through the bank, for example, of £833, but it's paid interest out of 39 grand. So its profit before tax is 1.4 million. There's no tax on that profit, and the profit for the financial year after tax is therefore 1.4 million. You may hear the term EBIT and EBITDA, or EBITDA, as it sometimes is referred to. EBIT is earnings before interest and tax, which in this example would be the operating profit, and because that's the operating profit stated before interest receivable and interest payable. EBITDA is earnings before interest, tax, depreciation and amortization. Depreciation and amortization are basically almost a way of depreciating your tax liability. If you buy an asset for £100,000 and you depreciate its value by 20,000 in the year, then on your balance sheet that asset will be showing as a net value of 80,000, and you will charge the profit and loss account that depreciation of 20,000.